Hey, welcome everyone. How you doing? Where's my? Oh, well, thought I forgot my cup there. Tonight, be enjoying the Bardstown. This is actually leftover from last time there. Bardstown out of Kentucky. I would love to go there sometime, and probably when the weather changes, I will. But I hope you're enjoying a drink here tonight with me. We're going to make this real simple. We're going to take some old lessons and see how they relate to what's going on now. And then I'm going to add a lesson on top of it there. You ready? Enjoy your drink. Wine, Gatorade, I'll pick on you, whatever you feel like. Oof. Pair that with a HVC Selection number one. Know what I'm talking about? Very good. It's freezing here, by the way. All right, let's take a look at some things. We know at the time of this filming here, it is, a couple days away from December. And so this is the rolling volatility that I've shared on the closing beat numerous times for each day of the year. And basically, we're just plotting volatility. The first trading day of the year is always the most volatile. Not always, but I'm saying on average over the long run here, it is the most volatile. All right. And then from there, it drops off. We go into February, March, April, May, June, blah, blah, blah. Summertime, really low volatility. The first time I pointed it out, we were talking about that. You come out of summertime, you get a lot of action. And then as we get into the holidays, the volatility gets a little bit lower. What does that mean? When we say volatility, why do we care? That volatility just means the wiggling of the market day to day. If you want to get fancy, you're saying the distance between the high and the low of the day. Was it far apart or was it really close? In other words, if the market just moved like this, it would have a very short and quiet range. If the market had a big range from high to low, moved, up 3, 4, 5%, down 3, 4, 5%, it would be a lot more volatile and aggressive. So when we show stuff like this, we're really trying to determine how volatile the market is at a given point in time, all else being equal and performing based on the average. But why do we care? If the market's volatile one day, so be it, right? We care because volatility creates emotion. Maybe not in you, definitely not in me. I'm dead inside. But it maybe creates a little emotion that causes you or other investors to do things outside of their original plan. The old saying, everybody has a plan until they get punched in the face. How many punches can you take during a day, a week, or whatever before you go, man, I was going to hold that stock, but I'm out. I was going to stick with the market, be an index fund investor, but I'm out, right? So volatility is important to know. Here's another way to look at it. I've shared this as the sell in May and go away slide to kind of prove my point. But volatility is important because we want to know if the market is going to tempt us into an emotional decision or if it's likely that we can look away for a little bit and not really have any big moves. So previously, I'd shared this on the closing beat with the sell in May and go away. Now we're going to come back and we're going to look at November, December. I want you to notice something. The blue line in the background. What in perfect heaven is happening right here? The low was set on October 27th. Did you know that the low in the market this year was actually October 27th? Ooh, spooky, right? We had a sharp rally out of that. Did you know that we just had a sharp rally? Oh, spooky, right? From here, we may very well go peak up to new highs. You see how that's coming up in the news? All-time high, new highs. Isn't that going to be crazy? Look that's normal. Picture the stock market this year. We had our pullback. We had a sharp rally that has taken us back to almost prior highs there. I think it's fascinating that this is the rolling daily return, monthly return, but we're plotting it daily for every year since 1950. In other words, this is the first day of the year's average. This is the second day of the year's average. And we're just plotting that to see what happens. Our stock market's doing exactly this up to this very moment right here. We just haven't poked out to new highs. Side story. Anyways, I'm looking in December. I'm wondering, is it going to be volatile? We know from the previous slide that volatility should decline throughout the end of the year. Tends to spike one last time, but tends to decline. I look here at the performance, the actual returns. I go, it doesn't normally get wild. It tends to spike one time, or in this case, decline and then recover. We're quiet. Okay, so December isn't normally volatile. Okay. You guys haven't noticed this, but all year long, I've been sneaking this stuff in here. Here's another one. The average range, I just shared this the other day, the average range of the S&P for the last 75 years in the month of December is only 4.7%. It is the lowest of all months there, meaning the average range throughout the month is plus or minus. We go up, 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 up. We go down, 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 down. We compare the low to the high. We have about an average of 4.7%. It's not a very volatile month, right? Pretty cool to be able to see that stuff. And one last thing, just so you can see that I keep all this data that I share with you. What are the odds that we have a 1% gain or loss on one particular day in the month of December? It's the lowest. 18.6% chance that we're going to have a plus or minus 1% day. Okay, so we know December's coming up. It is really calm and not known to be volatile. How can we add something to this? By playing defense, right? We are expecting December to be relaxing, happy, and full of holiday cheer, right? What happens if we get 3 plus or minus 1% days? That's not normal. What happens if we get a spike to all-time highs right at the beginning of December? That's actually normal. What happens if it pulls back real quick after that and we have a bigger range? Not more than 4.7%, but we have a bigger range. Yeah, that's actually normal, right? So we can play defense by understanding what possibly could happen going into the end of the year. It's fascinating. The other side to this is if you were planning on traveling during the December month, at some point, and this happens, and we have wild volatility, well, that's not normal. You now know that. Does it cause you to make an emotional decision? Probably not. Maybe you guys, you study and you're still here watching, you're learning from some of this stuff, but it will cause people to make emotional decisions. It will cause people to go, this year is different. This president, blah, blah, blah. The next president or whoever is running against this president, the wars, everything that's going on, you spend too much money, the government's printing. I agree with that one. But, these things will cause people to make emotional decisions. Will you be one of them that does that? And by me sharing these stats, my goal is, other financial advisors try to show you spend forever in the market, just you got to keep going. I like to share the stuff and go, things should be getting quiet here. We now have a series of data points to prove to you that the market likes to be quiet. Okay. We expect that. If it gets a little wild, my full attention is on what's going on. But if it is calm and quiet, why would I force it? Why would I get in there and try to do something extra and pretend the market's going to blast off to new highs and then go even further? So we're preparing ourselves by playing defense so that we're on both sides. If we're going to hold, we don't expect any chaos. We're going to hold. We're going to sit there and go through this. Maybe tax loss harvest, right? But if there's chaos, we have to recognize that's odd. That's different. We need to get in the game, right? If those things you can prepare for by using data, I think now you understand I'm not sharing data to make myself look smart. I'm sharing it because you can use it to prep your emotions and potentially prep your plan going forward. What are you going to do, right? How are you going to handle it? I love it. All right. I just had some fun with that one because I was looking through some of the old data and I'm like, wow. Look at how all this is playing out, and it's just using the data to go, we need to get busy. We need to sit back. We need to not worry. We need to panic, right? I love that stuff. All right. If you don't love this stuff, but you love learning there, we're happy to manage your accounts here at Jazz. We're financial advisors, full fiduciaries, but we don't call ourselves Jazz Financial Advisors. Notice we call ourselves Jazz Wealth Managers. We want to help with all of your wealth. We are not interested in just focusing on retirement. Any dollar that touches you, we want to make sure it goes to the right place, the most efficient place, and you can keep your dough straight. All right, off to the hot tub for me because it's like 40 degrees outside and I'm like, hey, this doesn't happen often in Florida. I'm jumping in. All right, enjoy the rest of your evening and thanks for hanging with me tonight.